Several weeks into the U.S. war with Iran, progress toward the war objectives, as well as potential investment in economic ramifications, remain fluid. Over the weekend, President Trump threatened to ramp up the intensity of U.S. strikes on Iranian power infrastructure if Iran didn't reopen the Strait of Hormuz to shipping, only to walk back those threats prior to markets opening on Monday. Each side is operating under different constraints. The Trump administration is very sensitive to markets, the price of energy, and domestic support ahead of midterms, while the current Iranian leadership is attempting to establish some deterrence to prevent future attacks. Right now, it seems that there is an inkling of progress toward a resolution. Given the severe disruption to global energy production and shipping, investors can take some solace that the overall S&P 500 index is only down 3.5% to start the year, while U.S. 10-year Treasury rates are only up 16 basis points. The signal from markets is that this conflict won't last much longer, but much depends in the short term on whether that signal is correct. The key chart for the global economy is the flow of shipping traffic through the Strait of Hormuz, which has collapsed since the start of the war. As a reminder, some 20% of global oil production ships through the strait. Several countries have begun negotiating directly with Iran for safe passage, but that has yet to result in a material resumption of traffic. The global energy market simply does not have an alternative to reopening shipping through the strait. Alternative routes in the Middle East, such as the Saudi East-West pipeline, can help bring the global shortfall in oil from 20.5 million barrels per day down to 12.5 million. Releases from strategic petroleum reserves can alleviate roughly another 4 million barrels per day of supply, but that still leaves a shortfall of 8.8 million barrels per day, equivalent to roughly 8% of global demand. If the closure persists much longer, the rising price of oil threatens to reverberate through supply chains. Even though the U.S. is largely energy independent, we still operate in a global market, and global supply chains are susceptible to disruption, particularly for industries where commodities are key inputs, from petrochemicals to fertilizers, to transportation, to even semiconductor manufacturing. One reason we think this conflict will resolve sooner than later is that the global economy cannot function with 8% of global oil production taken offline. To be clear, we don't think that the key risk is that the war with Iran turns into a new Iraq or Afghanistan. Rather, it's that in the short time this conflict persists, severe damage is done to key energy infrastructure. Last week saw strikes on both Iranian and Qatari gas fields, the latter of which resulted in 17% of Qatar's liquefied natural gas production coming offline for a period of up to 3 to 5 years. That translates to roughly 2.5% of global gas supply destroyed in one attack. Related to those attacks, Qatar estimates 14% of its helium production, a key input to semiconductor manufacturing, will come offline. Fortunately, the U.S. is relatively insulated from these supply disruptions, but our trade partners, particularly in Asia, are directly impacted. As we discussed in our last correspondence, to the extent there is a geopolitical risk premium priced into oil and gas, we think that U.S. energy infrastructure deserves a corresponding geopolitical safety premium, as it's thankfully located in a part of the world that's relatively insulated from the risk of such attacks. When we look at returns year-to-date across markets, we can see the benefit of having some energy diversification in portfolios, with that sector up close to 33% as oil prices have advanced 60% to start the year. While we wouldn't chase returns, we think that for portfolios light on energy, this conflict has served as a reminder of global dependence on conventional energy resources. We don't see that changing anytime soon, particularly given the energy intensity of artificial intelligence infrastructure and the push to electrify manufacturing and industry throughout the world. Despite the recent volatility, we still think long-term and patient investors can find opportunities in this market. While valuations are at the top of their 10-year range, some sectors with constructive outlooks like financials, healthcare, and energy trade at discounts to the overall S&P 500 multiple, and some high-quality firms with histories of consistent revenue growth, robust cash flows, and sound management have not been immune to sell-off pressures, creating more attractive entry points than we've seen in the last several months. If you'd like to discuss potential opportunities with us and how to mitigate against broader market and economic risks, please feel free to reach out. We hope that soon we can pivot from talking about conflict in the Middle East as the key market driver, back to longer-term structural growth trends, technological advancements, and the health of the overall economy. Thank you for your time and have a great week.